Welcome to Lunch Money. My name is Nick Samios. I am the fund manager here at Hermes Capital and your Lunch Money host. And Lunch Money is, of course, your online and social media home for workouts, capital raising, and special situations professionals. It has been an interesting past 6 months if you are in the special situations space. Basically, during COVID, there was a lot of businesses that got into trouble for obvious reasons, but there was a lot of businesses that didn't get into trouble because they were being basically propped up by the Australian Tax Office, being propped up by their banks, and I think the banks may or may not have had pressure put on them by the government not to precipitate any action. And likewise, a lot of suppliers refrained from taking any legal action. But all of that has changed a little bit. And I would just like to start off by, I thought that it'd be a really timely time, particularly as we're going into the holiday season, where a lot of small business owners have closed their businesses down over Christmas, and I've found traditionally that this is a time when people start turning their mind to some of the nasty notices that have turned up in the mail. And so I have two experts to assist us today to discuss what the nasty letters are and what to do about them. My first guest is Angelina Kazari. How are you doing, Angelina?
I'm very well, recovering from a flu, so I'm going to apologise for my croaky voice.
And you've had the proper flu, as you were telling me a little bit.
I have.
Yeah, but you didn't go into hospital, you survived.
I did survive, and I'm still a novid, touch wood.
Yeah.
Still haven't had COVID.
When I had influenza A, but unfortunately I had it with a touch of the man flu and I ended up in hospital. So there was that. Now listen, let me bring on our other guest, and that is Louisa Sijabat. How are you going, Louisa?
Going well, Nick. Hi, Angelina.
Hi, Louisa.
Now I'm just going to ask you both just to introduce yourselves by way of telling me maybe something interesting that has crossed your desk in the past week, and just to let our people know what it is you do and who you do it for. And we'll start off with you, Angelina.
Sure. My name is Angelina Kazari. I'm a partner at Holman Webb, and I'm obviously a lawyer. I have been in the insolvency space for over 15 years and operating predominantly in the SME space. I do a lot of work for insolvency practitioners, but also for directors and boards. I also do work for a number of non-bank lenders who also operate in the SME space. In terms of things that have come across my desk recently, I'm seeing a lot of defaults coming across my desk. I'm hearing a lot in the market in relation to the ATO enforcing debts and taking steps to recover funds from company directors and from companies generally. And like the slides that Nick presented indicate, there's been a spike in winding up applications recently after those court lists have been very quiet for the last few years. So definitely I'm seeing everyone ramping up on the recovery space. In addition, two of my partners at Holman Webb are very active in the recovery space for credit managers and the like. And they're also seeing an increase in work.
Okay. Yeah. All right. And what about yourself, Louisa? What's maybe introduce yourself, and also maybe something interesting that's crossed your desk in the past week or so?
For sure. So I'm Louisa Sijabat. I'm a registered liquidator and a registered bankruptcy trustee. I'm from Merchants Advisory. I undertake work that is liquidations, restructuring, bankruptcy, advisory, anything in that space, so voluntary administrations, all sorts of industries. So in terms of what I'm seeing lately is actually a lot of inquiries in relation to restructurings, and a lot of restructurings happening. It's tied in with what Angelina mentioned in relation to the ATO. We are seeing a lot of inquiries being driven by the fact that the ATO has issued them with notices or issued their company with notices, which I believe we'll chat a bit more about today, because we are seeing a great increase around this. And we're seeing a great increase around the use of restructurings to put proposals to the ATO to try and deal with this debt.
When you say restructurings, are you talking about the small business restructurings or just generally?
Yes, primarily the small business restructurings, although voluntary administration, as people may know, is a different form of restructuring as well. But the ones that we've seen the great uptick in is the small business restructurings.
Yeah, I actually have another slide here, again, courtesy of Alaris, and thank you very much, Alaris, for letting me use these slides. And you can see that when the small business restructuring first came in, really nobody was using it much, but it's really kicked off. The other thing that's interesting about the small business restructuring is that in the red column there is appointments of practitioners, but a lot of these restructurings do end up in a restructuring plan. So maybe we'll come back to that, because we'll come back to that, and you can tell us a little bit about what you are seeing in that regard. Let's start off with the first slide I had previously was the ATO. And as we can see, the ATO is absolutely is kicked off big time, and we know just anecdotally I think there's depending on who you're talking to, there's somewhere between 30 and $60 billion worth of uncontested small business ATO debt, which is all very interesting from a company director's point of view. But firstly, how the ATO sends the director a penalty, and it's either a penalty on the director personally or it's a penalty on their company. So maybe Louisa, just tell us what are the notices that a director might receive?
Yes. So the one you mentioned is the most commonly used one at the moment, which is the director penalty notice, sometimes referred to as the DPN. And it's the notice that the ATO must give a director, and that can include former directors as well as newly appointed directors, that permits the ATO to recover the company's unpaid amounts from that director personally. So this is quite significant because it opens up the director to personal liabilities, putting his or her assets at risk. And that includes personal assets, family, home, things in their name personally.
Okay. So it's just sort of delve a little bit into that personal aspect.
Yes. So if a company has outstanding liabilities with the ATO can issue these notices, which are called director penalty notices or DPNs, making recovery against the director or directors who have received these notices personally liable for the company's unpaid amounts. So the types of liabilities that the ATO can pursue directors for personally can include net GST, PAYG withholding, and superannuation guarantee charge, because as you may be aware, when that becomes overdue, it becomes the ATO's responsibility to collect it.
Now, I'm assuming that the DPN, when the director receives this director's penalty notice or DPN, that's not going to be the first time they've heard from the ATO.
It should not be. Their company should have been receiving notices in relation to collection, unpaid amounts, and they should be well aware of those. It might be the first correspondence they receive in a personal capacity. However, they should be well and truly aware of what's happening in the company. So the tax debt itself shouldn't be a surprise to the director.
Now, Angelina, most company directors, they may have started off sole trading or in a partnership. They've gone to see their accountant, and their accountant said, look, you really need to protect yourself personally. So form a company, and that way you won't personally be liable for debts. But Louisa is telling us that when you get a DPN, all of a sudden the ATO can take you personally. So do you just want to talk us through that a little bit?
Sure. And this is, I think, one of the problems. Theoretically, there's a corporate veil which shouldn't get pierced, but there are a number of things that directors can be personally liable for, like we've been discussing. there's director penalty notices which sheet home a company's tax liabilities to a director. And there's limited ways to avoid those. And I assume that we'll be talking about those in due course, Nick. But obviously, there's also personal guarantees that a lot of company directors provide in connection with operating their businesses, and those can bring those liabilities of the company back onto a director. And then the other unfortunate piercing of the corporate veil that tends to make directors liable are insolvent trading claims in the event that a company goes into liquidation, and only a liquidator or a creditor of the company in some circumstances can bring those insolvent trading claims, but they only arise when the company has already gone into liquidation. In terms of the director penalty obligations, though, it's been historically a very good avenue for the ATO to recover debts, particularly when the company itself doesn't have the means to make the payments. It adds an additional layer of pressure onto directors to make sure that they're not allowing companies to continue to trade when they're not able to do so financially.
So basically, it's a stick that the ATO has to precipitate you to pay. So what? Obviously, you know, we've got a lawyer and an insolvency restructuring accountant. What? I get one of these DPNs. What's the first thing I should do? I'll start with you, Louisa.
Act quickly, because the time is ticking. They usually provide 21 days in which the recipient, so the director, must do something to deal with it. Otherwise, the DPN is then considered expired. So what are the things that can be done? What are the options that the ATO gives for adequately or satisfactorily dealing with the DPN from the ATO's point of view? So what the options are depends significantly on whether certain lodgements done by the company were on time or within a tolerable guideline provided by the ATO, or whether they were later than that. So I'll be a little bit more specific. So for something like PAYG withholding and net GST lodgements, the ATO says that if these were lodged, so obviously not paid, but lodged within 3 months of the due date, then that's the tolerable period for that. And for super guarantee charge or anything related to superannuation, they must be lodged when the due date was. Now, if that's the case, and that's the type of outstanding debt that the company has, then in order to what they call remit, or essentially fix the DPN problem that has been received by this director, the director can either put the company into a voluntary administration, small business restructuring, a creditor's voluntary liquidation, which is the type of liquidation that the company initiates, or pay it. Now, pay it is usually the least viable option. Otherwise, they typically don't let it get to this stage. However, they have 4 options. If you're outside those tolerable periods for lodgement, and the company has a debt from those periods, then the only way the director can fix the DPN is to pay it. And usually by that stage, that may not be such a viable option to the director.
Yeah, it's interesting. I mean, obviously, we've been getting a lot of inquiries lately with people who've had DPNs in various stages, and I'm not, I'm obviously not across all of it, but I understand that there are different. Sometimes the DPN, the tax debt's attaching personally, and sometimes it's not. We won't necessarily get too much into the weeds there, but yeah, they're having to either sell assets or raise capital or go into an administration or a combination of all of those. Angelina, if you've got a director and they ring you, or the accountant rings you and they're sitting with the director and they've got a DPN, what's the first thing that you say to them that they should do?
Well, if they obviously, it depends on what the nature of the DPN is. So if the DPN is one that gives you 21 days to do something, those options definitely need to be explored. if I can just sandwich what Louisa has said, before a DPN is even issued, it's essential that the records of the company are kept up to date, because what I've seen happen a lot is that DPNs are validly served on directors at addresses that they no longer reside at. And so keeping your ASIC records up to date when it comes to directors' home addresses is so vital in terms of the DPN process, because what tends to happen, or what I've seen happen quite a lot over the last 15 years, is that people get these director penalty notices in the mail at a former address, and they don't find out about them until that 21-day period has expired. And that is a disaster. So before that DPN is issued, it's essential to make sure that all of your records are kept up to date with the ATO and with ASIC. The second thing that I want to note, before a DPN is even issued, as soon as a company is in difficulty in terms of meeting its tax liabilities, you need to be engaging with the ATO. And the third thing, prior to a DPN being issued, is to really be alive to making sure that tax lodgements are made on time, even if they can't be paid on time, that they're made on time, just to maximize the options that you have once a DPN has been issued, so that that personal liability may be able to be removed by winding up the company, placing it into a small business restructuring or voluntary administration like Louisa has gone through. That's particularly important in an economic situation where people cannot generally afford to pay a lump sum amount personally, where a company is not able to pay the ATO debt that it owes. Then following on from the issue of a DPN, the ATO needs to commence proceedings against the director in a court where the jurisdictional limit applies. So usually those claims have been brought in the district court in New South Wales and the county court in Victoria and courts around that level. And once the proceedings begin, there are a couple of defences that can be raised, but they are generally on a very general level. They're not really defences that a lot of people have available to them. So you can't say, for example, that it's a defence to a DPN that the notice was issued to a former address that you no longer live at. If you haven't updated your details with ASIC, the notice is still validly served, whether or not you still lived at that address. There's no need for it to be personally served or anything like that. And it seems a lot of directors are really, surprised by that, because you would think with something that serious that there needs to be a level of verification that notice has been received, and there is none. So that's why I've sort of put as the caveat to all of this is that it's on a director, and it's a director's responsibility. And for any accountants out there, it's something that you should be really advocating to your to the directors who you represent. It's so important to keep your details up to date, because not knowing something can be an absolute disaster.
Okay, now, so basically we've got, make sure your lodgements are up to date. Make sure that your address is right, because burying your head in the sand and hoping that you didn't see it, that's not going to work. I do know that often when people get into a bit of difficulty, they have a fight with their accountant, possibly because they haven't paid the accountant's bill, and they're they might be switching accountants. They haven't, the old accountant got the notice and nothing's happened about it. The other thing is that a lot of small business people, obviously, they're flat out, particularly this time of year. And they're just pushing these notices across their desk. And then, maybe they're watching this and Christmas is over and they're going through their mail and there it is. And some of the clock's already ticking on this. Have I left anything out?
I'm just going to raise one other thing. It's not just directors that notices come to. It's also the company itself. And when you're talking about pushing notices across your desk, in light of those slides that we've just seen, the precursor to the ATO or any trade creditor trying to wind up a company is issuing what's called a creditor's statutory demand for payment of debt. So if you see that form, you need to act immediately, because if a 21-day period after service expires, a company itself is deemed to be insolvent. And that's a statutory presumption. So when people are going through their mail around this time of year and deciding what can wait and what can't wait, there's two really important documents that can never wait: a statutory demand or a direct penalty notice, because they both have very strict time frames in which you have to do something.
Okay, so we'll come to a stat demands just shortly. So just recapping, don't ignore the notices, make sure your details are up to date, make sure your lodgements are up to date. And as Louisa said, you could fall into a bunch of different categories. Depending on what category you're in, the options are different. So you need to speak to a professional ASAP to make sure you know which category you fall into. I don't want to spend a whole time talking about the ATO, so just very quickly, and I'll ask you this question both. I'll start with you, Louisa. As we know, people very often, their lodgements aren't up to date. They didn't open the mail when they should have opened the mail. It's the worst case scenario. They've got 10 days to go. What are their options? What's your advice? Who should they speak to, and what should they do? And they've suddenly had the wake up.
Yeah, ring Angelina or myself ASAP is the first step. And then we will talk you through what's available to you in your situation at this moment. Now, if you haven't done your lodgements on time, or they're still not done, look, it is what it is at this stage. We can't go back and change the past. But what we can do is say, okay, it's this sort of size of debt. You have these resources, whether that's nil to some number, halfway, 80% to whatever the debt amount is. These are the options given the amount of the debt and the extent to which you might be able to pay it, whether some portion now or some portion into the future. And it will become a very personalized situation by that stage. Okay.
All right. Okay. So that's the ATO. Now another source of pain is that supplier that's run out of patience. And I showed this other slide earlier, winding up applications. Now, obviously, some of those ones in yellow or orange, depending on how colourblind you are, and I'm not sure, is the ATO. But there's also a lot of other actions who very often trade suppliers who, as I say, have run out of patience. Now, those stats there, Angelina, were winding up applications. So do you just want to? And you mentioned the statutory demand. So do you want to just sort of join the dots on those two for us?
Yeah, sure. So when it comes to trade creditors, as opposed to the ATO, in my experience, they will usually commence proceedings if there's any dispute around what debt is owed. So often when it comes to trade creditors, this is not the first time that you're hearing about this liability, because the statutory demand is frequently based on a judgment debt. What happens with a statutory demand is if a company owes a debt that is over $5,000 now, I think is the statutory limit, then a creditor's statutory demand can be issued. That document is served on the registered office of the company. It can be sent by post. It does not need to be personally served. And what that form effectively says is that you being the company, owe the creditor money, and that if you do not pay that amount or compromise a claim to the satisfaction of the creditor within 21 days, then the company itself is deemed to be insolvent under the Corporations Act. Now, if there is a presumption of insolvency that arises after the expiry of a direct penalty notice, the creditor will ordinarily commence winding up proceedings in reliance on the expiry of that period and the presumption of insolvency. And so the creditor will commence proceedings in either the Supreme Court or the Federal Court, or potentially sometimes the Family Court, although I don't know why anyone would really do that. but in the Supreme Court or Federal Court, and seek an order that the company be wound up. Once that happens, your options become a lot more limited, because I'm sure Louisa will raise that you cannot appoint your own liquidator once a winding up application has been filed.
The statutory demand, what does it look like? Does it say statutory demand across the top? How do I know I've got one of these and not just a garden variety notice of demand?
It will ordinarily say it's a Form 509H and a creditor's statutory demand for payment of debt. It will usually be accompanied by a covering letter saying we enclose by way of service a creditor's statutory demand for payment of debt. And it will have a certain format. It will have, usually in bold writing or in a box, a notice saying very loudly that you must do something within 21 days, or there's a presumption of insolvency. It is a prescribed form under the Corporations Act and under the Corporations Regulations, but they can look a little bit different from time to time, and substantial compliance with the requirements under the Act will still be a valid statutory demand in most circumstances.
I think they're a little bit like spiders, aren't they? Like, you know the ones that are going to kill you. You don't know. You don't need to get your spider book out. As you said, they look different. And yeah, okay. So Louisa, you get a director contacting you and say, listen, I've got this statutory demand notice. Look, to be honest with you, I was really busy last week and the week before that I actually got it, but I didn't open it up, and now I've got 7 days to go. How do you work out what to do next?
Yeah. So this depends on who has issued that statutory demand, how much that debt is it disputed, is it not, and is there any prospect of paying? So what I'm trying to say is, the summary version is, step one would be, can we sort, or can you as the company director sort something with that creditor in the next 7 days? Is that plausible or not? So then the path divides from there. If that's plausible, I highly recommend you go sort that ASAP. That could involve a lawyer, it could involve your accountant, it could involve a broker doing some sort of refinance to pay them out or something like that. Now, the other branch or the other path is, I cannot sort that out within that time. They're not likely to accept any payment plan. I don't have funds. What happens next? So that would then proceed to expire. That statutory demand would expire. And it will be unresolved, as in no payment or no satisfactory arrangement has been entered into. What happens from there? Do you want me to keep going, or are we?
You've just raised.
We'll go to that point, to that intersection. Yeah. Yes.
Well, the first thing is, there was a question I meant to ask before, and you mentioned payment arrangements, and so that I sort of just call back to the ATO there. Once the ATO's commenced action, my experience these days is that they're no longer interested in payment arrangements. Is that a fair call?
Sometimes. I think if you're going to put a payment arrangement to the ATO and proceedings have been commenced and recovery actions are underway, you're going to need to have around 50% of the amount due ready for a lump sum payment for the ATO to even start looking at a payment plan. Or you're going to have, say, a property that is up for sale or has been sold with a contract due to settle in a short period of time. You're going to have an unconditional letter of offer from a financier to provide a significant portion of that debt, but you're not going to be able to get a $10,000 a fortnight payment plan put into place. You're going to have some material payment made in a very, very short period of time in order for the ATO to even look at a payment plan.
Okay.
That's been my experience as well. It matches that quite precisely.
Right. Yeah, it's interesting. I mean, I get people come to me and they say, look, I need $2 million to pay the ATO, and that might shock a lot of people, but there's a lot of those big numbers going around. And I do the maths, and we lend against accounts receivable, we lend against equipment, we lend against property equity. we do all the maths and we go, you know what, we can actually only lend you $1 million based on the security that's available. And I suggest that through, they seek professional advice, of course, but instead of writing a check for the ATO for the whole amount, which, well, firstly, we can't get to that number, but what they should do is throw a large number at it, 50%, 40%, whatever they think they can do, and tackle it that way. So then getting back to the trade suppliers. So you've sort of outlined some conditions there where the ATO may or may not, having commenced proceedings, be negotiable. With trade suppliers, when there's a stat demand, in your experience, are they open to negotiation, or once they've gone that far, that's they just want to see it through?
In my experience, it can go either way, and it depends who the trade creditor is, what your relationship with them is like, including any ongoing relationship. And then those trade creditors will, again, like the ATO, in all likelihood, only be willing to negotiate on pretty strict terms that involves, a very short-term arrangement. What I suggest is that before you get to that point,
I might pick up from there if that's all right,
That's
Nick.
all right. Yeah.
I don't know exactly what Angelina had in mind to express on that one, but what my experience matches what she was saying in relation to it could go either way with trade suppliers, where usually by the time it's gotten to a statutory demand, it's a bit hard to come back from, but not impossible. And the reason I say that is most trade suppliers in their credit department will try and keep an ongoing customer as long as they're viable and as long as it makes sense for them to do so, depending on whatever their internal credit policies might be. They obviously need to get paid. That's part of the business model. And a lot of them do really try and work with their customers because that's how they came to be owed money in the first place, that they are customers. And they're typically our account managers trying to keep the relationship going. However, what happens is by that point, sometimes the need to enforce the credit policies might take over for business reasons, and the payment requirements might become a bit more stringent as compared with what they were in the past. So you can come back from it. It is hard. It is uphill, which is not a surprise to any directors at that point, but it is with difficulty.
And can I ask you, often, just on this technical point, but it's important for company directors and their advisors to understand. Sometimes we get asked, someone comes to us and say, look, we've got a statutory demand, and it's for, $200,000. And they say, can you pay that so it'll go away? And what we say is, well, yes, we'll certainly make those funds available, but you need to have the whole, because once it's gone to court, you need to have the whole thing dismissed, because otherwise, even if we pay, the person who's suing you, someone else can step in. So do you just want to sort of, in layman's terms, just briefly outline what it is? Yep.
Totally. So we've talked about the statutory demand. Look out for it. Look out for the big heading that says statutory demand. So if that expires, so that has the 21-day period. If that expires, the person or organization or company that issued that statutory demand has the right to file what's called a winding up application in court. Winding up is a word or phrase that means exactly the same as liquidation. So what that means is if a statutory demand expires, that creditor has the right to apply to the court for the liquidation of the company that hasn't paid. So that is obviously very significant to that company that hasn't paid. The winding up application can be filed as soon as practical after. It could be a day or 2 or 3, depending how quickly that lawyer can prepare the documents or what the creditor's instructions are to their lawyers, or they might sit on it for a while. So it depends at that point. So once you do have the statutory demand and it's expired, it could be at any point in the future over the next few months that a winding up application, apologies, that's my eco lights,
Right.
that a winding up application or liquidation application can be filed by that creditor. And then once that has been filed, the court allocates a hearing date to that hearing for the liquidation. And that's that hearing date that we've been talking about indirectly previously.
Okay, you're back with us, Angelina?
I am. My whole computer just died.
That's okay. All right, no problem. So what we were
I'm on my phone now.
That's okay. That's okay. What we were just talking about was I mentioned that sometimes I get asked to provide finance to pay out a statutory demand or a wind-up notice, actually, or more specifically, a wind-up notice. And I say to people, and we can pay that wind-up notice out, but it's no good paying it out until the matter's been dismissed. And Louisa was just talking us through that. And I just wonder if you've got a lawyer's perspective on that. Because obviously other creditors can jump in and step in, even if I pay out creditor X.
So, Angelina, if you want to jump in from the filing of the winding up application to its dismissal, because that's the portion we haven't covered.
So, when a winding up application is filed and you engage a lawyer, you usually have the first return date a couple of weeks after the filing of the application itself. As a lawyer, I will usually put on an appearance and set out any grounds of defence to that statutory demand. The grounds are relatively limited. One of the grounds is that the company is in fact solvent. Another is that that you're asking the court to exercise its discretion not to make the winding up orders. That notice, once the winding up application is filed, the notification of that filing is a matter of public record, and a creditor will have to put notice of that application onto the insolvency notices website. So everyone becomes aware that this application has been filed. I know a number of creditors that monitor those lists, and there are a number of companies that send out daily alerts about winding up applications that have been filed. So if you have another creditor who you owe money to, they might see your name on that list and then file what's called a notice of appearance. And they'll be in that proceeding as a supporting creditor. So even if you pay out the person who's filed the winding up application, that supporting creditor can then seek orders to basically step into the shoes of the creditor who filed the application and rely on that presumption of insolvency from the failure to comply with the statutory demand. So basically that they step into the shoes of the creditor if the proceedings are dismissed, and that the company is still deemed to be insolvent because of the expiry of the demand, even though they didn't issue it themselves. So if someone like Nick comes in and pays out the creditor who filed the winding up application, and the day that you are at court seeking a dismissal order, someone rocks up with a notice of appearance in their hand and seeks leave to file that in court and seek orders for substitution, there's little that can be done to stop that process happening, which is why someone like Nick will have, terms around any finance that's given to get rid of a winding up application.
So really, part of the response to receiving a wind-up application, is simply not. Well, it depends on your financial situation, of course, and so you've got to go to the experts to get the advice. But it's also to be aware of who else might substitute. I mean, just to sort of, because it's like a tag team. So Killer Kowalski may have been paid off, if that means anything to you, but. Hulk Hogan might just be standing there just on the tag, thank you very much.
Well,
now
in terms of a war story, at one point, and it may still be the case, I held the record for the most number of adjournments of a winding up application in the Supreme Court of Victoria, because every time my client paid out a creditor, a new one would pop up. And it got to, I think, 13 adjournments because new creditors would pop up every time. And it's a very, it's a difficult thing to deal with when you have those creditors that are lining up behind, and it can be more than one creditor. I had another matter recently where there were, 7 or 8 supporting creditors sitting behind the petitioning creditor. And so you need to be alive to the attitude of your other creditors as well.
Yeah, I mean, I had one this time last year. I got into a big fight with the client's solicitor, and the client's solicitor was not an insolvency expert. They got most indignant when I suggested to them that the client needs to go and see a lawyer who knows what they're doing. In this, because this lawyer was saying, "Oh, listen, just pay it out," and I said, "Okay, buddy, what's going to happen when I've depleted this guy's borrowing capacity to pay out that creditor?" And then they get to court and another creditor pops up, and this solicitor says, "Oh, well, that's just the risk we'll have to take." And it was like, well, not with my money, It was, it was very sloppy advice, if you ask me.
I don't know any lender where that would be acceptable risk.
No.
It doesn't matter how much interest you're proposing to charge. That's an unacceptable level of risk.
No.
It's like that arcade game where you whack a crocodile and another one pops up, and until you've done all of them, you're still alive in this game. So you do have to deal with all of them, or at least have an understanding or plan for the whole situation altogether.
Okay, listen, we're running out of time, and I really wanted to get to my next one, which is the notice from the bank. Now, I had a advisor call me the other day, and he said, my client's got a 100-day letter from the bank. Now, I've not really heard it called a 100-day letter before, but it was a letter from a major bank to the customer, saying that we've reviewed your facilities, and they're none of them being renewed. And there was an invoice finance facility and some equipment finance, and I think a business term loan. And as I say, we can see that the banks are all ramping up their activity. I mean, it sort of goes up and down there. But if you were to sort of put a trend line through it, it's definitely trending up. How does your advice change for someone who has received a letter from the bank saying, you've got until the end of February to refinance all your facilities? Louisa.
Sorry.
Angelina.
I was going to say, there's so many options out there beyond the major banks, and despite what I think is the myth that any non-bank lender is completely is uncommercial, or lends on riskier terms. It's not necessarily true especially when you're refinancing out of a major bank with no or limited defaults. You have so many options available to you. If you get that letter, engage early with a really good broker.
Yep. Now I've got a very specific scenario. I've had a few of these lately, so I'll give you one example, Louisa. I had one referred to me by a good finance broker, and one of the major accounting. Well, firstly, the client had been transferred to bad bank, and we'll just talk about that in a moment. And secondly, they were being monitored by one of the major accounting firms. And I'm pretty certain that that major accounting firm, just like Sylvester having little sort of baked chicken thought bubbles when he looks at Tweety Bird, I'm pretty sure that was going on with this major insolvency firm. Do you want to sort of talk us through, firstly, what happens there when a client is transitioned, from their friendly banker out at Chatswood branch into town, or into bad bank, as we call it? Well, firstly, just talk us through that, and what, as an insider, I mean, you're an insolvency person, as an insider, what's really going on when that file is being monitored by one of those big accounting insolvency divisions?
Yes. Okay. So lots happening there. So bad bank is an informal term that people like us in the industry use to describe a situation where, or to describe the department that exists in Pretty much every bank and financial institution, it definitely exists in all of the major ones. For bankers who are specifically trained for, well, they refer to it as all sorts of things, but special situations might be how they most nicely call it. Essentially, when there's either some sort of default or something that goes outside normal operating scope of the account or facility, or that they are trying to transition the customer on to some other financial institution. So they are specialist bankers. They're usually centralized within the bank, and their job is to work out what to do with this customer and how to exit them from the bank. So the majority of the time, the bank typically prefers the customer to exit by refinance and by agreement and consent, and that both parties agree. Now, sometimes the customer might be so far in default that they are not paying anything on any facility, say in a worst case scenario. The workout banker or the bad banker has to then work out, what do we do to try and recover the bank's money from this situation? And they will go about that in a variety of ways. One of the things that you mentioned there is that monitoring by an accounting firm. They might be a major accounting firm, they might be a mid-tier accounting firm. This is certainly not a cheap exercise typically. And the company will need to be providing financial information to this accounting firm, who will then typically assess and provide their recommendations or report to the bank on an ongoing basis what the bank should do. Should the bank appoint a receiver and take control of this business? Should the bank try and let the customer work out their payment plan? Should the bank try and let the customer refinance, or whatever it is? Unfortunately, from the customer's point of view, it's typically in most banking agreements that the bank can charge the customer's account for the accounting firm's fees, and the choice of accounting firm, the fees, the fee budget is usually within the bank's decision. So it usually puts more stress on an already stressed customer.
And Angelina, what sort of advice do you give someone? Do you pick up the phone to the bank? Let's say they've been given 60 days. They've got the insolvency firm hovering. How do you sort of triage the situation?
Yeah, look, like most things, I am a big advocate for engaging early. So definitely engaging early with the bank, but more importantly is to engage early with alternative financiers. And that can really be the deal breaker when it comes to having a good outcome. So, for example, a letter of offer coming from a reputable incoming replacement lender will usually be enough to buy a little bit more time to get everything in order without the large accounting firms being appointed to undertake investigations. And unfortunately, like Louisa has said, the costs of doing that can sometimes be the difference between being able to refinance and being stuck and having a shortfall in what you're able to obtain to pay out the larger bank. So it is really important in that respect to engage early, to try and put off any formal appointment or informal appointment of an insolvency practitioner to do either an investigative accounting report, or take any precursor steps to their appointment as a receiver.
And just by way of wrapping up, because I think this is a record length lunch money already. What about bank haircuts? Have you had experience with those? Just to give you an example again, we certainly have. We bundle together the assets and we go, okay, well, we can afford, based on the security, we can lend X dollars. Of course, we don't want to give the bank all the money because we want to make sure that the customer has some working capital moving forward. So I had one scenario, for example, where we worked out we could raise $2 million. We estimated, obviously working with someone like Louisa, that they needed $500,000 worth of working capital. So we go, right, we can raise 2 million, $500,000 has to go into working capital. That means the bank can have 1.5 million. Now the bank was owed 3 million in this case. And so we showed the bank our calculations, and we said to the bank, look, 50 cents in the dollar, I mean, you got to be very humble because the banks sort of view it as a bit of an insult, but that was the reality of the situation. And in this particular instance, it worked. Depending on who I speak to, people say that the banks are more open to those sorts of conversations at the moment. Other people say no. What's your experience, Louisa?
I think I'm not aware of what the trend is at the moment, but I've seen it on a case-by-case basis, where in your case, you understand what's happening with the company and have been able to communicate it in a way that the bank understands as well. And that's actually a very important part of this process, because banks don't like taking haircuts unless there's a really good reason. And it's about demonstrating to the bank why their interests are being properly considered as best as possible, and that they are being looked after, and explaining why in language the bank understands and numbers the bank understands, that this is the best possible outcome for them and there is no better outcome, and hence this is why it's recommended.
What about yourself, Angelina?
I would say there's two really crucial things before going into any negotiation, but particularly this negotiation, like Nick and Louisa have just pointed out. Going prepared. You need to have the numbers. You need to have you need to be giving the banks, or any creditor really, a basis upon which to accept what you're saying is true. The second key principle when it comes to negotiating with banks and with any creditor, again, is to engage early. The more antagonism that arises due to a lapse of time, the less likely that a commercial outcome can be reached, because we are all human and it tends to be that emotions will get in the way. So engaging early and honestly and openly to the extent that it's necessary or desirable is a key, in my experience, of getting a good outcome with any commercial creditor. Like I said, the longer you leave it, the more anger underlies any negotiation. So keeping those doors open, even if you don't have great news for banks, I think is a real key to getting a good outcome on a negotiated basis. But certainly, Nick, I've seen discounts be given, and quite significant ones sometimes, because banks are commercial enterprises and they understand commercial risk.
Yeah, I mean, look, again, it all comes down to if they think it's a better outcome financially, and also timely outcomes as well. I mean, there's been scenarios where we've said to the bank, look, we'll get your result. It'll be by the end of next month. Here's what the result will be, and it's obviously less than ideal, but particularly, I found that it's particularly where there's regional scenarios, it seems to work better. I've had a few, I guess, in the last sort of 12 to 18 months where there's been a regional scenario. It means I think that sort of plays a little bit more on the bank's calculations. Look, I'm going to say thank you very much to you both. So thank you for joining me and for giving us I guess what do you call it? The guide for the non-professional. I will say, I always say to people, I'm not an advisor. I'm just a financier. So yes, we have solutions if you've got wind-up notices, ATO pressure, or pressure from the bank. But I only have one piece of advice that I'm happy for you to sue me on, and that advice is to seek professional advice. So I would say that I am going to wrap up. with a bit of a Christmas message. I would like to say to those who celebrate Christmas, have a happy Christmas. If you don't celebrate Christmas, well, I wish you all the best for this festive season. Have a safe and happy holiday with your loved ones. Now, we have got here at Lunch Money, we have created a little bit of content for you to dip into over the summer period. We had a great interview with the author of this book, Duncan Maven, the Pyramid of Lies, Lex Greensill and the $1 Billion Scandal. And I think, you'd really enjoy reading this book, but I'm sure that you'll also enjoy Duncan Maven's interview. You could maybe work on your communication, personal leadership, and personal persuasion and influence skills by dipping into our recent Lunch Money with Arabella McPherson. That was absolutely fantastic, and you will definitely get some benefit there personally. If you're a professional that needs to sell, lead, persuade, I 100% recommend that you take a look at that podcast or have a listen to that podcast. And if you're a director or a commercial finance broker, we've given you lots of meaty stuff to get into today with Angelina and Louisa. So once again, Louisa and Angelina, thank you very, very much.
Thanks for having us, Nick.
Thank you very much.
No worries. Okay. Cue the outro.